Hello, hello. Looks like nowadays, whatever stone you are gonna be picking up, you are gonna be finding an EV company below. So we're gonna talk about Rivian Automotive, a company that you may have recently been aware of, mainly because Amazon mentioned it in its earnings report. Some of you may have known it before that, of course, but it really came to light because of that. Amazon has a big stake in the company, and that actually helped Amazon's earnings a lot. And this is why people have suddenly become very interested in the company. But we need to examine and see whether it actually makes any sense to actually own it, regardless of what Amazon is doing, because we don't want to be copycats. We want to be understanding the company and its projections and financial model, and see whether it makes any sense to actually add it to our portfolio. Now, you will see here that the company at some point used to be sitting at around 170, 180, has dropped massively, uh, really a lot. But it's a new IPO. And you will see the outstanding shares here that they have been increasing a little bit, kind of to be expected when we're looking at a new company, a new IPO. So that doesn't worry me too much yet. Now, we're not going to be having too much data about the company because it's a new IPO, but we still can examine a few things, see whether this is a potentially interesting addition to our portfolio. So, the financial analysis of the company, we can take a look at the income statement, and again, we don't have much data here. Maybe it makes more sense to take a look at the quarterly instead. Again, we don't have too much data, but what we can see is that the net income of the company is still in the negative, and that's the first thing to examine when you're taking a look at these companies. Kind of to be expected potentially because these kinds of companies tend to enjoy massive growth in the first few years, and so you can see a negative value here and still potentially have an interesting company to invest in. Although what I don't like is the steep decrease here in terms of the company's net income. That's a massive decrease. And obviously, EVs and cars are companies that don't have high margins. They operate on very low margins because they have high expenses. And so they tend to be very trendy these days. But can they really make money? Car companies are not great at making money. Let's just say that and leave it there. But still, let's take a look at what the company could potentially be doing in the future. So total current assets, the company still has some assets here, current assets, but what about their total equity here? It used to be 2.35 in 2020. This remember, this is not the yearly. This is just the quarters, and so now it's actually going down a bit at 4.2 billion dollars currently. And cash flow of the company, yeah, the cash flow from operations is in the negative and actually decreasing rapidly here, and the company spending more and more. You see here that the net income is in the negative, massively in the negative. Okay, company still investing a bit, mostly in capital expenditures, something to be expected as well. And as you would expect, a lot of income coming in from financing, just because the company has to be getting some debt or issuing shares and the likes. What happened here is they actually issued debt, so they are not diluting investors at least, but there is some debt going on right now, 5 billion in total, the last 2 years, looks like. Actually, this is quarters. Actually, I forgot about that. This is actually quarters. And this is the last 12 months, really, so this may be a bit skewed here, so it may be similar to this value. We'll examine the total debt. But the free cash flow of the company is again sitting in the minus and rapidly decreasing here. This is a massive loss here. I'm assuming this has to do with the massive capital expenditures over here. Yeah, this affected the free cash flow by a lot, of course. And the solvency here, we can take a look at the debt. Yeah, the company has amassed some debt right now. Typical for car companies. They do tend to like getting a lot of debt. They have to, and so that's not great to see. And I'm assuming that the multiples are going to be super high as well. Yes, 25. You need to be looking at much lower than this eventually. But again, this is a company at the later stages of growth, I'm assuming. And I just wanted to see some year-over-year growth, but it's not even depicted here. Yeah, so this is a very new company here, sitting at a 54 billion market cap though, and that's extremely steep. So this is a massive market cap for a company that's not making money and actually losing a lot of money. I just cannot see myself entering here for any reason, even though the company could still be doing well in the future. I just don't have enough data here, and what can I go with? I don't have a PE, I don't have a price to free cash flow ratio, I don't have a price to book here because everything is negative, and I guess I should have a price to book. The company has assets, but still, the PE ratio, the price to free cash flow ratio, these are all not applicable here. They're all in the negative. And we're looking at a company that is again has a $54 billion market cap, not making any money at all. So what kind of valuation could I justify here? I'd have to be an oracle to really decide whether it's worthwhile here. And the thing is, based on what the company is making right now, this should be much less. This doesn't make sense. So it's massively inflated because of people buying the stock. And the fact that people buying the stock could actually, and probably will eventually, prompt the company to actually issue more shares into the future. And right now they don't have issued many, but I wouldn't be surprised if in the next 5 years you're looking at a company that has increased its outstanding shares to 1.5 billion, for example. I wouldn't be surprised to see that at all. And so that's something that I can't invest into myself. So currently, even though the company could be projected to have some year massive growth in terms of sales, I don't know how you can project this kind of insane increase in sales here. If that happens, we're looking at a much better picture here, from $16 billion to $3.5 billion for fiscal year 2022. That's interesting. Very interesting. I cannot really go from something that's projected into the future when it's like such a massive difference, of course. And even then, even if the company was making this kind of money right now, even right now, this kind of market cap is not, it doesn't really match the sales. Because again, if we're looking at the free cash flow, it's going to be much less. And the market cap is still at $54 billion. So, even with this kind of growth, I wouldn't enter the stock right now. I mean, yeah, it is what it is. These kinds of companies can be hyped up companies, but I'm not actually recommending hype in my channel. I'm trying to help investors achieve financial growth by investing into companies and companies really, that make sense and actually bring money back to stockholders, and not just rely on hype. Because when you rely on hype, at some point when this hype dies down, so does your investment. So you have to be very careful to avoid that. Hope you enjoyed the video. Hope you got an idea about Rivian. It's interesting, but not yet. Probably a buy. And if you did enjoy the video, please leave a like and subscribe to the channel. And join our Discord channel. You can find the link in the description below. We're already more than 15 people, I believe. And we're waiting for you. Come join us. In the meantime, take a look at this video that I made just earlier. It's about PayPal and whether it's an interesting opportunity right now. Thanks for watching this one, and be safe. See you soon. Bye-bye.